how many transactions can I do at one time? Okay, all Fannie Mae and Freddie Mac lenders underwrite the same way: income, assets, credit, and it's all math. So what we do is when we get you pre-approved, we tee up one loan in the system, and we usually put a sweet spot in there, say 150,000, which is usually kind of a sweet spot of price points throughout the Real Wealth network. And then we go through and pre-approve that, and then we come up with the math, and the math gives us a ratio, and the ratio means that we take whatever your income is, gross monthly income, we take whatever your current debt is, and then we add the mortgage debt into there for the investment property, and then that comes up with a number. The number typically, and it varies from some lenders to the other, and also if you really crutch the Dodd-Frank Act, but it's supposed to be 43. We go up to 50, okay? So if we stay within that 50 box, you're good. Now, what we do, and we'll talk about a little bit later in this webinar about giving credit on the rental income, but what we will do, if you're buying a property and it's got a tenant in it, okay? Let's say you're buying it for $100,000, you got a $1,000 a month rent on there. We're going to give you $750 for credited back toward those ratios to offset any indebtedness that you may, if we have to exceed over the 50% mark. Okay, so if technically, if you're buying 3, and this is one of the things that we used to do, but we can't anymore because a lot of the investors don't like to see that, is we will give you credit. Let's say you're doing 3. We'll give you credit on the subject property for that loan, regardless if it has a tenant in it or not. We know that the average market rent based upon the appraisal is going to come in at the same thing they're going to rent it for, which in this case is $1,000. We're going to give you that $750 regardless. Now on properties 2 and 3, if they are empty and we're closing at the same time, I can only give credit for that number, for that first property. I cannot give income credit on properties 2 and 3 unless they have a tenant in it. Okay, so I run into this a lot of times where people are doing multiples, and a lot of times their income supports it. Sometimes they don't, and sometimes we have to throttle the investor back, saying, well, let's go ahead and get one, get a tenant in it, let's move to the next. But it's all math. Okay, so we are giving you credit if there's tenant occupied on properties 2 and 3. We'll always give you credit on properties 1, which is the subject property. Okay.
Got it.
This talks a little bit further about what we just talked about. Compared to rent, okay, same thing. All right. Once again, if you can buy 1, you can buy 10 as long as the numbers work out.
So the bottom line though is, if one's right on the edge of their debt to income ratio and they want to buy 3 at a time, they might not be able to, because numbers 2 and 3, you're not going to count the rental income if there's no tenant in them. So they'll just buy 1, let the dust settle, buy number 2, let the dust settle, buy number 3. They just might not be able to do all 3 at once. They just have to be a little more patient.
Exactly. Okay. A few years ago, we used to actually give average, if we were doing all 3 properties, we would have appraisals on all 3. We would have the average market rent analysis on all 3. We would actually give you that income. But the Fannie Mae investors, for some reason, they just don't like that anymore. They like to see those tenants in there.
Mm-hmm.
Okay. Now here is a new one. Do you have to have landlord history? And the answer is no. That's really an old requirement that we used to do years ago, and it used to be 2 years. In other words, that income that we talked about giving you 2 years ago, they wouldn't give you unless you've been a landlord for 2 years, okay? But that's since changed, okay? The Fannie Mae implementing the requirements determining when rental income can be used to qualify for the purpose. The changes to be intended for the borrower purchasing the investment property without prior history and managing the rental properties. Now, let's go to the next slide, and this kind of explains. Now, this is what's changed. This affects people that are not renting. They don't own a home. They're living with mom and dad, okay? They need that rental income on the subject property to qualify, okay? The new Fannie guides just came out in December. If you are and this, I had to read this about a dozen times where it finally sunk in. If you own a home, that's a good thing. And you have a mortgage, that's a good thing. And you've owned it for more than a year, or you've been paying mortgage for over a year. And one of the things that doesn't say in the Fannie guidelines, it's in parentheses. I didn't put it in there because it's extremely confusing. Or have housing expense, which means you can own a home or rent, either of the two, and you have the history to prove that you've been making those payments to the landlord or the mortgage company for over a year, we will give you full credit of that 75% we talked about in the previous slide. As an example, once again, $1,000 a month income, or excuse me, yeah, $1,000 a month rent, $750. Now, when you put the loan against that with a 20% down, you're probably going to come up with, somewhere around the, say, the 650 range of principal, interest, taxes, and insurance. Okay. So if you bought right, which you did, obviously you're gaining an additional $100 to be given toward your debt to income ratio. That's if you are a mortgage owner for over a year and receiving some kind of rental income, mainly the mortgage over. Okay. So where this comes back to haunt the people that are not renting or have or renting or not renting or have a mortgage is that we will give you the income just enough to offset that payment. I know this sounds minuscule, but $100 either way sometimes on a lot of borrowers, it can swing your ratios either way. But we will give you just enough income if it's less than 12 months to offset the payment. Once again, $1,000 a month rent, $750 credit, payment $650. We're not going to give you the $750. We're going to give you the $650. So it's really not a bad thing, but it is something that just recently changed. So from a landlord standpoint, you really don't have to have landlord experience. From what we're looking for is stability of people making their mortgage or making their rent. That's what they're looking for. Freddie Mac the same way. Pretty much everything I explained with Fannie Mae is the same way as the Freddie Mac. All right. How long does my pre-approval last? Well, in our world, in the Highland mortgage world, when we get all your information up front, we take a look at your credit earnings and your assets. Your credit's good for 120 days. You can buy one or you can buy 5 houses in 120 days, and we still only pull your credit once. If after 120 days we do not pull your credit again, unless of course you come to me with a contract, which at that point I would have to re-up it. So technically your pre-approval, if you don't make any radical changes to your world, going out and buying a boat or something that has a negative influence on your ratios, then really it's good indefinitely. Keep your job, credit's the same assets, same income. If it's all the same, it's indefinite, okay? But once we get that, after I say 120 days, we get the contract, we're going to go back and revisit that whole equation, make sure nothing has changed, but really it's good forever. So if you're out looking for a house and let's say the 120 days has lapsed, give me a call, say, Graham, I'm about ready to make a purchase on a house here in Ohio, and I need a pre-approval letter. No problem. I'll look you up. We'll take a look at everything in the system. And of course, I'll ask right off the bat, anything changed? Nothing. Then I'll go ahead and, in good faith, go ahead and send you out a pre-approval letter so you can capture that contract. Once you get the contract, we'll re-up the credit. Nothing's changed. Move forward and go to close. Okay.
Do people have to kind of like keep, every paycheck, they have to send in the pay stub to you and stuff? No. Okay.
No, we do a snapshot up front just to get you pre-approved.
Mm-hmm.
And then when we're ready to go, whether it be a month from now, 6 months from now, we want to get just things current, which means the pay stubs will be within the last 30 days. The asset statements, bank statements will be in the last 2 months. And of course, updated credit. So you really don't have to update anything once you give it to me once. And it's like tax returns, it's good for all year. Right. So really, those are the only 2 things would probably get updated. It's just the pay stubs and the bank statements.
Okay.
Technology is great. and it has advanced? And the answer is yes. Everything we do virtually, I mean, I'd love to say that I have a chance to face-to-face all my clients, but I'd say probably less than 1% I get a chance to face. That is, if you live in Dallas and you're trying to buy something here, you're welcome to come by. But beyond that, we do everything online, and we have a really slick system set up where we send you a link to the application page of the website. You go on there, you fill out the application, it'll give you a prompt, and then you immediately set up your own little dashboard. If you're looking at the screen, you'll see that you have your own little dashboard. This particular dashboard happens to be one that's designed, well, let's see, my loan. Yeah, it is for the borrower. Okay, good. So the dashboard itself, you can see there, if you can see the really bad writing here, I've uploaded my W-2. See the little green check? I've uploaded my W-2s because you've already checked the box there. I've uploaded this, that, and the other. It's like your own little tool that you have that shows you what's going on with your mortgage in real time. And then when we get going, we order the appraisal, the title work, and so forth. Then you'll move on to the next step, to the processing. Then the green light will go off there once it goes to processing. So you get to see in real time where your loan is. And the cool part about it is that the referral partner, whoever it may be, has their dashboard as well because it's connected. Now, keep in mind, none of the privacy information is disclosed. All it does is give activity on the loan. So, but yeah, you can see everything from beginning to end. It has its own little uploading ability, which is great. It's highly secure. People are very, very, very nervous about their documents these days, and they should be. So we have an upload portal there that you can upload all your documents, and oddly enough, you can even do it from your phone. So, and then when we go to close, we'll inform the title company that we're ready to go. We'll send the documents over to the title company. The title company at that point will set up a mobile notary to come to you because typically you're going to be out of state, and the mobile notary will come to your home, place of business, after hours, on the weekends, whatever's convenient for you. They will bring the documents to you. You will sign in front of them, and they will go ahead and notarize it, and they'll take the documents back with them, and they'll overnight the documents back to the title company. That's where everything comes to the point where it's not completely online. Now, I'd love to say that helps the people in third world countries that are doing loans with us, but stay tuned to your nearest channel. We're almost there with a complete e-signature package where we can completely eliminate having the mobile notary piece, and everything will be done online. So we're on our way, and there are a few companies that actually have adopted those, and we're in line for that as well. So I mean, for people like in Japan that have to go to a consulate, to get that U.S. mobile notary or that U.S. notary goes away. So it's going to be a lot better here in the next couple of months. So that's a good thing.
Nice.
All right. This is a good one. Can I use a HELOC for the funds? The answer is yes. Home equity line of credit. They're fabulous. I have one. I think everybody should have one. If you own a home and you have some additional equity position in your house, obviously go get one. It's very easy to get one on your primary residence. It's almost virtually impossible to get one on your investment property. And Ben, I think we've talked about this. I think there is some people out there doing those, but the terms and rates aren't that great.
Yeah, I mean, I'll just go ahead and jump in. I hope it's okay to. I think it's okay to use names.
Absolutely,
but, yeah. I needed to get some. I wanted to explore doing HELOCs on investment property, and a lot of times credit unions will do them. But like I'm here in Florida now, and the USF Federal Credit Union would do it for investment property, but only for properties in Florida. Then I talked to a couple other credit unions, and they would do it, but they had weird requirements. Like one said only if you had 4 or less loans. If you have more loans than that, then for some reason they won't. But Wells Fargo, of all people, in their nationwide, they will do a HELOC on an investment property. I've done it twice. They don't make it easy, but I got it done.
Now, do you still have one in place, Ben?
I do, yeah.
Perfect. That's great. Well,
about a year ago. I mean, it was, the rates, they vary from like 5 or 6%. And then, they have teaser rates that last for, so it ranges between like 3 and 6%. So it's not bad.
No, not at all.
But it's working well. And someone just sent us a question saying Union Bank will do them also, and that they have 3 of them in California. So and he or she pays 27%, 7%. So they're available. You just got to do the work and just go into a bunch of banks and ask them that question, and they'll let you know right away, yes or no.
And I think we're going to probably see more and more come online very slowly, of course. And I think you say you're right. It's going to be, they're going to make it very strenuous to get it, but I think they're available. And I'm glad, like Wells Fargo, as much as I like to throw darts at them, I'm glad that they're actually doing that. And I know one of the guys over there, I may give him a call afterwards because I got some additional equity. But yeah, they're great to have. So HELOCs are a working tool that I highly recommend. As an example, I've got, if let's say a property came my way and I didn't have some surplus of cash laying around. Well, I'm going to tap into my HELOC, and you can do the same. Okay, the HELOC funds can be used for your down payment and your closing cost. It cannot be for your reserves. Okay, now let me just kind of go through here. I'm just going to download all these real quick for us.
Yeah.
When we take a look at your loans, like at your profile, like I say, we look at credit, earnings, and assets. Okay, well, on the assets, we would prefer to see liquidity, which just means that the money's in your personal checking account or money market, something you can access immediately. We do not, prefer cash mattress money. And if you say, well, I've got $100 of cash sitting in my house, well, you need to deposit, because if you don't, you have to season those funds, which means you got to put it in the bank. You got to let it sit there for 2 months. And the reason for the seasoning is, if you recall, when you asked a moment ago, Ben, about what do you get updated after 120 days, those 2 months of bank statements, on those last 2 months, if we don't see a large deposit on those last 2 months of statements for $100,000, then we're fine. We know it's your money. But if we see that $100,000 on there, then we're going to ask where it came from. You're going to say it came from my mattress. It's been sitting in cash in my house. We're going to say we can't use it, unfortunately. That's pretty straight across the board. We're for Fannie Mae. A lot of times people, when they set up their LLCs, and I think this is a good way to go. And I have, oddly enough, I have a business checking account for each one of my properties, because I like to, at the end of the month, is to see, my intake of rent, and then of course my outgoing of the mortgages and the expenses involved. And it just kind of keeps me current on what's happening with that particular property. And then at the end of the year, I'll recap those statements and take a look, what kind of my profitability was. But if you're going to use some of those funds from like an LLC account, that's fine. A lot of times, a lot of lenders will ask for a CPA letter, which means your CPA will say, yes, utilize these funds, and Graham Parham LLC will not affect the business itself, because the LLC is a business. But to get CPAs to write those letters sometimes can be a little tough, just to let you know.
They get nervous.
Yeah, they do get nervous because they're extending their liability. So just keep that in mind. Non-liquid accounts, of course, we don't like to see. But one of the things at the bottom here I just put up was the gift funds. I had a call just yesterday. And I see this happen a lot with, like, son gets out of college. Dad's got a portfolio of, say, 20 properties. Hey, son, you need to start investing in property. Okay, Dad. Dad goes, here's $50,000. Go ahead and get you one. So kid comes to me, says, I'm ready to go. Here's my 50 grand. I just deposit. Well, let's go back up the chart there. Remember we talked about the seasonality there? We're going to have to wait 60 days on that. Yep. And the guy called me yesterday. We're partners, okay? And a lot of times, and this is really good information too, husbands and wives, they want to maximize their lending potential to grow their portfolio as much as they possibly can, and they want to use leverage for the whole thing, and that's a good thing. In the Fannie Mae and Freddie Mac world, we have limitations on the borrowers that they cannot go over 10 loans per borrower, okay? So fine, the husband will do one, the wife will do one, so forth and so on. And the same thing happens with partners, okay? These two guys came to me and says, we want to do this, but I want to have this guy do the loan first, but the other guy's going to give him the money. Well, guess what? He's got to wait 60 days because it looks like a gift, okay?
Right.
So this is some of the stuff that during my interview, when you call and talk to me about your strategy and how you want to proceed forward, I make sure that you don't make these type of mistakes. Okay.
Yep. Hey, don't advance, because I've got a quick question on
Sure.
here. Now, that third bullet point, non-liquid funds are allowed if they are exercised. Now, real quick, Non-liquid funds meaning, I don't know, your E-Trade brokerage account with a bunch of
Right.
Netflix and Apple stock. In other words, it's not liquid unless you sold the stock and transferred it to the brokerage, to the money market portion, and then transferred it into your bank account. So it's non-liquid, but you'll use those things. It's okay to use that for reserves.
Exactly. And I'm glad you
Okay.
brought that up because it wasn't on the slide. If we go back up to the top there where it says the HELOC, we can do down payment closing costs, and we cannot do the reserves.
Mm-hmm.
We can do, non-liquid funds, IRAs, 401ks, whatever the case, just show me the statement. Even though
Yep.
we're not going to tap into it and you're not going to use it, we
Yep.
all know that. We just want to have it as reserves.
Your Fidelity blue chip mutual fund that's got 62,000 in it, but you want to keep that mutual fund, but okay, that counts as reserves because we know in an emergency you could use those funds.
Exactly. It just strengthens you as a borrower. And that the great thing about it, over the years, it's got to the point we used to give percentages of the total of the asset. Now we're giving the full 100% of the asset. And some lenders will vary from one to the other. How much can you use out of that, and so forth and so on. But we give the full 100%. So that's a good thing.
What does it mean what does it exercise mean? Non-liquid funds are
Yeah,
allowed.
well, like you said, the stock, you got 100 shares of Apple sitting around.
Mhm.
Well, you got to sell it. So you got to show me a statement how much it is when you sell it. You got to show that once you sell it, the transfers of money into your account. Okay, it's all a paper trail.
Right, but you don't need to sell it
No,
if you're
you don't.
using it for
No,
reserves. Okay,
no.
good. I just want to make sure that. Okay, perfect. Thank you.
You're
Next.
welcome.